But yeah,
Michael, you
yes,
actually made it to Nashville.
I did. I did. You know, I was told though by like several people already that if I had come last week, that it was like covered in
Yeah,
snow.
it was. We got dumped with 9 inches of snow, so that wasn't fun. So your timing is great. Look
I
at
did. Do you guys have snow removal? You guys have like all the snow removal
no,
stuff?
we let nature do its thing.
You do? Oh my gosh. It's kind of like, you know, well, in Boston, obviously there's snow plows and there's ice trucks and there's everything else in between. And in Arizona, like even if it rains a lot, people are freaking out. There's nowhere for the water to rush and go, and it tends to sit,
Yeah.
and people struggle to drive.
Yeah, we came to a bit of a standstill last week with the snow, but we made it through.
You did. Hey, you also made it back from your trip from India.
Yes,
How was
it
that?
was amazing. I went for my niece's wedding and it was an incredible trip.
Yeah,
And you made it back from Japan.
I did. I'm supposed to say something in Japanese, right?
You should.
I did, you know, and for those that know, I've been studying Japanese now for 4.5 months or so. Yeah, so like Nihongo ga wakarimasu, you know, I understand Skoshi, a little bit of Japanese. I'm working on it. It's a work in progress. So do not send me these like, you know, things of, you know, Japanese. I still can't read the text, but I can speak some. But the thing that's a real killer is that travel. My goodness, it was like a 16-hour time difference for me. It's something monstrous.
Yeah, it was almost a 12-hour time difference for me. How long was the flight for you?
Why? Are you just saying that? You're just saying that.
I want
You want
that.
that? Okay, it was awful. It was we left the hotel, which I know is not your question, but I'll answer it. We left the hotel at 8 o'clock in the morning in Japan to take the subway to the Shinkansen, the bullet train, to to the airport, to the Narita airport, where we were there at the airport when the earthquake hit.
That it's as dramatic as it gets.
It was. I wish I could say it wasn't. It really wasn't. It wasn't like everyone was falling over, but it was that happened. And then the entirety from flight to flight, there were 3 flights. By the time we get back, it was 28 hours of travel. Yeah,
Yeah,
yeah.
my thankfully no the earthquakes for me through the travel, but it does, from home to home, it does take me good 30 plus hours to do. My flight this time around I was flying direct from New York to Delhi, and it was a 17-hour straight shot. It was not fun.
I know you have to like really want to go. We need to start our market outlook.
Yes,
We have, by the way, I think we've consolidated this thing.
a
Yeah.
lot. Yes.
So again, so for those of you who are listening to us or watching us live, there's an element of this that's also kind of like they call the AMA or Ask Me Anything component. So Josh is he's there and he's ready. So for your questions, as you have them, do find the chat button on your Zoom link and hit him up with questions. We did get some questions, so thank you for sending those. We're going to try to weave some of those throughout the presentation to make sure your questions get answered. But I do want this to make sure that each of you have an element where you maximize this time together so that you leave with a greater understanding of what's going on in the world, economically speaking, financially speaking, and ultimately your portfolio. That's the goal.
Yeah, that's absolutely the goal. Do you also want to maybe give a quick recap before we start for anyone who's joining us for the first time on what to expect in the next hour?
Do I? You know, yeah, right. So that's correct. Yeah. So for those of you that are new to our quarterly market outlook, what you'll find is that we're going to spend the next hour or so going through all the relevant economic data points that we can find, where we are looking for information about where we're going economically, where we've been, use historical context to then bring that information to present day to say, well, what should we be doing with portfolios? And we're giving you an inside look to our insight. So, some of you may be wondering, like, well, great, so what have you done and what are we doing and where are we going? Because what we also realized in this process is that there is just an inordinate amount of data and of newsletters and websites and all of this stuff, and we want to provide clarity amidst all the clutter, because we have nothing to position only just again, how are we going to best grow, preserve capital for your money. Yeah,
sounds great. Let's dive in.
Okay, geez, all right, let's go. Okay, I'm going to share my screen here. All right, wonderful. Market outlook. Here we go. In action. So we've got 10 different areas to cover. And again, if you want this market outlook, we're happy to send you the PDF version. Just please drop Josh a note in the chat, drop us an email afterwards or whatever, or your InterOcean contact, and then we're happy to get you our latest. And we also just came out with their December performance numbers.
Correct.
If you want those, we'll send them to you too.
Sounds good.
That's right. Okay, so in terms of the 2023 performance, interesting, because when we started the year in 2023, the prevailing thought was recession. And it's interesting. So we didn't get a recession. And not only did we not get a recession, but the market did quite well. You know, the market got walloped in 2022, down 18.5, and bonds down 13. And what a rebound that we had, and if you look here, if you look in the middle, we got the kind of the second half performance, but really it was all in the fourth quarter.
Especially the last 2 months of the year.
Yes, and we've got a lot of data on that,
Yes.
but that was really it. And so you don't, and this is again, you never want to try to market time, and this is a case in point why. I mean, this fourth quarter, this chart, this chart, whether it be stocks of all kinds, higher yield bonds, regular bonds in purple, even alts, everything performed in that fourth quarter, really November, December.
It did. And again, like, you know, we're calling it the everything rally, and we do have a few more slides on that. It's just across the board. Everything just was feeling that excitement that, you know, the recession that we were all talking about never happened, and it will probably never happen, and we're fine, and there are so many things that are now completely under control, and there's nothing to worry about. It's upwards and onwards from here was kind of the—
What a relief.
Yeah.
I guess we're good. Should we end the call? No, but that's right. But that's what
that
happened.
was the sentiment.
In the sense, and then so in another representation of that, we're in interest rates, and we'll talk more about that and how that interrelates with the market and the market performance. So we'll try to, in addition to covering the information, give you some educational perspective. So if there are also things that we're saying, you say, well, what exactly does that mean? Another good thing to hit Josh within the chat, because Bhavin and I do the best we can to break stuff down. But you know, if you need more information, please let us know. So here's your everything rally. And you know, we did have some folks. We had some folks that were heavy cash. And
we're leaning in that direction. Again, I remember having these conversations with some of my clients saying that, you know, money market funds are paying roughly around 5%, treasury yields are hovering in that range, and that 5% sounds really good. And, you know, it's probably what all I need, and therefore it's okay. I don't want to go through the stresses of being invested in riskier assets. And a lot of those conversations at that point were also, from my point of view, were that if a risk-free asset is offering in something in that range, the riskier assets just feel that pressure too, and have to, you know, deliver more than that risk-free rate. And again, no one could have predicted the disparity between the risk-free returns and the riskier asset returns that could have been in 2023. But here is a chart that actually shows you what widespread disparity there was.
Yeah.
Especially, you know, when we look at the last two bars on this slide, you know, the tech stocks in general had a very, very strong year, knowing very well that, you know, 2022 was quite a struggle for those tech stocks too. So, you know, you kind of have to keep that in perspective too. But the Magnificent Seven, you know, that's been the talk of the talk of the street. And look at, you know, the average returns there. It's just phenomenal.
Yeah, I mean, it's one of those things that, you know, thankfully and gratefully, we had significant exposure to the Magnificent Seven in our portfolios, thank goodness. Because that's where the concentration of returns was, as you said. And, you know, with the market up 26%, that is not an insignificant return, but my goodness, was it heavily tilted towards that. We'll talk more about the 2022 decline and the rebound and what that means. But cash, which looked good at one point, was just, you know, turned out to be in huge difference in terms of its performance. And this is another way of looking at how concentrated those returns were towards the end. And the 60-40 or stock, 60% stock to 40% bond portfolio, November and December up 12%. Stock only, the S&P 500 up 13.7, November, December. Bonds, as interest rates collapsed, because all of a sudden this overwhelming feeling that the Fed was going to be cutting rates massively in 2024, Bonds go up 8.5%. So what was looking fairly ugly in October has had a very sharp reversal, all based on the Fed and interest rates. And that is a big concentration in the rest of our slide deck, which we'll get through. One of the things that we would want to talk about together is here this kind of whether or not there's so many people that are flooding into the market that it's overvaluing stocks. Has the buying gotten out of control? And Bank of America does happen to have a pretty good, pretty broad study of this information. And what you see is that no, this is indeed not like a top in terms of how many people are flooding into the stock market. You see, we're still above kind of that baseline average, but we're nowhere near, kind of like these historic buy signals. So I'm not seeing anything in there in terms of stock ownership that's alarming. So we can't get much from it. We always look at these data points hoping we could get something, but there's not much there.
Right.
And when we're looking at the concentration, though, in the top 10 stocks, Bob, that's where you see it's like, there's just such a concentration now in the Apples, the Googles, the Microsofts, the Amazons, and clients are coming to us all the time with low basis stocks. And I find, I'm telling you, it seems like it's 1 out of every 2 or 3 new clients are coming to us with these low basis stocks that are requiring us to do these covered call writing positions for, which is just a very different dynamic than you'd see in other markets.
True. And it kind of also, the conclusion I would want to draw from this segment is that it kind of is interesting to note that the frenzy kind of feeds itself. It kind of becomes a self-fulfilling prophecy at some point, wherein the big tech stocks, the Magnificent Seven, which is driven by that AI frenzy, which was driving, as you could see from the chart on the right, which is driving a lot of people to create more concentration in their portfolio. So again, people are getting more and more driven towards that thought, saying, what's the takeaway from 2023? If you had a very heavily concentrated big tech portfolio, you had a great year. Should that be a strategy worth considering ever? No, but 2023 proved you wrong. For someone who only had 7 stocks in their portfolio, hands down crushed it, outperformed every benchmark out there.
But I wonder what the number is going to show if you owned in the past 2 years.
Correct. That would change things significantly. And we do have a slide on that which does show, for example, there are 4 tables that you see. So there's a little bit of a data to get through, but let's start with the first table on the top left, which again talks about the average Mag 7 returns last year was about 111.7%. Compare that to a 26.3% for the S&P 500, which is still pretty impressive. But again, look at that dispersion there. And the chart, the second table, so we move, we're moving from left to right, still staying on the top of the slide, is showing you that quarter on quarter basis, a significant amount of that S&P return was being derived from these Magnificent Seven stocks. For example, in the first quarter and the second quarter was where most of that, concentration happened. In the first quarter, the Mag 7 return was actually 103% of the S&P itself. Same story kind of continued in Q2 as well. Yeah. We did see the fourth quarter showing a little bit of a market, breadth widening. So there were more things that were doing better, not just these Mag 7, but we still ended the year with almost 83% of the S&P return coming just from these 7 stocks. So again, the key story last year was concentration. But to Michael's point, if you just zoom out a little bit and look at, what these, what these indexes have done on a 2-year horizon. So now we're looking at the fourth table on the bottom right there. Look at the S&P 5 return over a 2022 and 23 timeframe on an annualized basis. It was not as impressive. It was about 1.7%. And the small cap stocks and bonds actually really struggled over that 2-year combined period. So again, we're being highlighted with, a really stressful 2022, an amazing, at least on the face of it, an amazing 2023. But when you kind of look beneath the surface, it isn't that impressive. And another data point within this table is also, what if we
Yes.
actually also paid attention to trying to adjust these returns with inflation and see, okay, on an inflation adjusted basis, how impressive were the last 2 years? And you just come back with really, really disappointing numbers, both for, across the board, as whether it's S&P 500, Dow Jones, small caps, or bonds, the numbers were ugly.
We just want to have some perspective. Hey, can I highlight the energy thing?
Absolutely.
Can I? So yeah, we got a couple things, by the way, thank you for the questions. Keep them coming. Josh is there. He's sending me messages, which is wonderful. The question is, we can't get into specific sectors or individual stocks, take too long, but broadly speaking, we are aware that energy struggled last year, and utilities as well. You can see it demonstrated on the chart on the bottom left. And for that reason, there are certain parts of the portfolio, certainly some of the ones that we have in Arizona, where we are focused on energy distribution and energy companies as well, because we do see some opportunities there. We do see a pretty resilient price for oil, especially given everything that's going on in the Middle East with some of the consternation there. In terms of a country by country basis, I don't see any real difference between what we would expect from a US based stock or a Canadian in the energy side, but we're appreciative of the fact they both had a really difficult 2023.
True. I'll add maybe a couple more comments, and thanks for reminding me. I did forget about.
This is what we do. This is what we do. Yeah.
I would say that, again, you kind of touched upon this, that the forecast for this year for energy prices is in a pretty good balance. It's kind of in that $80 to $90 range, and generally the consensus among most economists is that it would be a year which would be fairly balanced in terms of supply cuts and demands. And the OPEC is trying to kind of walk that fine line, and they always are. They would probably still keep a pretty tight leash on making sure that the demand and supply matches up, and therefore the price kind of stays in a tight range.
Right.
But another interesting thing about last year, although in terms of returns, energy sector didn't really do as well, but there was a lot of activity that went on in the sector last year in terms of very big M&A deals. And interestingly, most of those acquisitions were almost fully sponsored by stock acquisitions. So instead of paying cash, the companies did make sure that they were using the fact that 2022 was a really, really strong year for them. So they're sitting at some good stock prices, and they were monetizing on that to acquire, assets. So that does put them in a really good spot for this year. These larger companies, whether it's Exxon, Chevron, etc., are starting the year with some really good assets under their belt now because of those acquisitions.
Yeah, we're seeing acquisitions in the Permian Basin a lot. And we haven't even talked about we don't in this one either, the Strategic Petroleum Reserve, but we're aware that that's low. We're aware that's got to get built back up again, but that's a different topic for another day. We'll have to get to that next quarter. Give me the next slide. Why is that so big? Okay.
And then again, continuing on that concentration theme, another graph that we see on the screen now is just what percentage of stocks within the S&P 500 that actually ended up doing better than the index itself. And again, in a historical context, it was a fairly low number, less than 30%. You can see the bar all the way to the right of the chart, which again, is a pretty obvious signal that there was a fair amount of concentration in how we got the returns.
And we haven't seen that kind of concentration since the dot-com bubble bursting. So maybe we have another year of it. But if so, it would be unlikely to think we'd see a third.
Right. And again, you do have a side note towards the end of this slide, and I'll read out aloud, saying that historically, market leadership tends to narrow as the profit cycle, decelerates. And then, investors are kind of gravitating towards lesser number of companies that they feel more confident about can do better, if there were, slowdowns coming. So this could also be more of, that kind of phenomena in the background, saying, there are lesser and lesser companies that are projecting that kind of a confidence.
You're saying things are slowing down. I think we're saying that. You know what the government's saying?
Yeah.
Analysts are saying. Let's get to the data though. Oh, sorry, too many.
Um,
How about this one? Do we have any data? Yeah, we got some.
Yeah, we do. And this is just quickly touching upon the S&P 500's valuation multiples, where we're sitting now. And if you look at the table on the right and just the three highlighted rows, that kind of tells you how much of, again, 2023 was a strong year for the market. And that kind of shows you how much we've moved up on that, multiple expansion. For example, December 2022, look at that.
I'm gonna size that for you. I know, by the way, good job. Our screen was taking over. Go ahead.
The
Sorry.
forward P multiples at the end of 2022 were in that 16.8 times range. And, cut to a year at the end of last year, we're sitting at 19.6, forward multiples for the S&P 500. So again, if you look at a lot of different historical reference points, those numbers are rich, they are pricier. And as we'll talk about quickly in the next few slides, that forward multiple also implies that we are essentially expecting the corporate earnings to grow by a little over 11% in the calendar year 2024, which again is it's a pretty big hurdle for
especially coming off a year with no real corporate earnings.
Over the last trailing 12 months, the growth was 3%. So we're going from what we've achieved, which is a pretty nimble number, 3%. If you skip forward, we actually have that. Yeah. So again, granted that if you widen out the analysis and look across all developed regions, the US is expected to lead that earnings growth number if that 11% can get delivered. In comparison to every other developed region out there, US is definitely kind of leading the charge in terms of higher expectations, but that is still a lot of pressure.
It is
to put on already elevated valuation levels, saying you've got to deliver this, otherwise, the math doesn't really work out as well.
It doesn't. And now Ken asked a great question. Thank you, Ken. Keep the questions coming. We love them. Whether or not the Magnificent Seven is done, whether tech stocks have plateaued. I think so. We're gonna answer this more directly, Ken, but let's just be clear, is that 2022 was a small disaster for the Magnificent Seven. We saw a full rebound in 2023. So they're largely treading water. We know why that they rebounded this year. AI, as Bhavna mentioned, is a huge component of it, but whether or not we see that moving forward, we want to go to that chart. We don't have. Oh, yeah, you've got that. Yeah.
I did, on that topic of Magnificent Seven, we were, Michael and I were looking at another data point wherein essentially this analysis was done of kind of running a screen across the board on all G7 countries, not just the US, to try and see how many companies actually filter out with let's say 25+% earnings growth. And again,
that's a big year.
It is, and 25% is a little bit of an arbitrary number, but it just kind of is trying to portray that we're essentially trying to look for companies that can have a stellar year.
Mega growth.
Which has been the theme of the AI, frenzy, that there is mega growth coming across the board. We can't even truly measure it. So 25% seems nimble in that context. And only 3 of the Mag 7 companies showed up on that filter. So it does kind of, again, one can make an argument that, we haven't truly fully understood the scope of monetization of AI. And that might be the reason why companies are not still, already saying that we'll have 25+% earnings growth year after year. That's true. But it is, again, a big hurdle to cross.
January,
even for Mag 7s.
In January, companies don't just go out and tell you that we're going to be blowing out our 2024 numbers. There's really not a lot of benefit for them to do that. It's not entirely uncommon, but look at, I think the sector by sector look, and I like kind of, this just ties in, I think, with what you were
Right.
just saying, but
Right. Actually, on that the chart on the right of does talk about the guidance. To your
it
point,
does.
like companies don't really go out and talk about we're going to have a great year next year.
We're gonna blow the earnings out. Well,
Right.
you're giving
So
yourself high wire.
which was kind of the theme, and you look back at the last earnings cycle and you look at what were the companies indicating in terms of what to expect. There was more of a negative theme across the board, and you can kind of see that with the positives and negatives kind of marked out for all sectors in the S&P 500. And predominantly the theme was there were more negative comments being made about saying, just be cautious, things might be starting to slow down, etc., versus saying, we'll have a stellar year in terms of earnings growth.
Exactly. I hope we answered Ken's question. At least we did for now, Ken.
Yeah, and there's more coming, Ken.
There's more coming. All right, we'll talk about the bond market. And so, mind you, the stock market is reflective of investors and analysts' thoughts about where corporate earnings are going. Where are these big publicly traded, are their earnings going to rise? If so, the stocks tend to rise. The demand to own those stocks goes up, and then the price moves with it. Bonds also will tell us a story about what the expectations are of the economy. They just tend to do it a little bit differently. Tends to be a different bond investor versus a stock investor, but we don't need to get too deep into the weeds about what that is. But bond investors, historically speaking, just tend to be maybe a little bit more negative, and stock investors tend to be a little bit more optimistic anyway. So, but beyond that, what I would draw your attention to on this is particularly on the left-hand side, just where interest rates were ending the third quarter, September of 2023. That's like kind of that blue line, and where they were at the end of 2023, which is the yellow line. And you're looking at that in terms of the shortest treasury bonds, all the way on the left-hand side of the chart, and then the long-term treasury bonds all the way on the right. And you can see we had that negative sloping yield curve, which we've had for a while, where short yields are higher than long, but there they were in blue. And then in yellow, boom, it just collapsed down with this expectation. My goodness, the Fed is going to be cutting rates, and then the market moves in anticipation of all that happening. Hasn't happened yet. The Fed hasn't cut anything. But the market doesn't wait for it to cut, and neither did the bond market.
Yeah.
People were, very actively very actively moving based on that information. And one of the things that we'll get into high yield spreads in a minute, but we'll get into that. And not only did the US Treasuries here on this chart on the left perform in that November-December timeframe, because you can see, like, as the chart shows that the gold line goes down, prices go right up. Those are yields going down and prices rise. You saw that huge move. That just gives you a sense of the scope of it. And then municipal bonds below that, tax-free bonds, where they also had that climb where, oh my gosh, rates are going to continue to move higher. There's realization the Fed's going to cut rates. That also had a precipitous move. We're looking at the year-over-year change. It's pretty flat for both, but what a remarkable short-term run. And if you're looking at things like on the municipal bond index, that's on the right. It shows it was those last 2 months of the year, muni bonds rose about 9%. It was a massive move in the tax-free part of the market. So as a result, we've been lightening up a little bit for some folks on our municipal bond exposure, because what a wonderful run that they've had. And it just makes us wonder that, given where we are going this year and where we are this year, whether or not the Fed's going to follow through, because the market expecting the Fed to cut rates does not mean the Fed's going to cut rates.
Right. And again, there is one thing about, okay, they may be getting, so their actual comments were, we think that we're done with hiking rates.
Yes.
And then the market read that as not just we're done with hiking rates, no longer higher for longer, and we're going to turn around and have 6 rate cuts this year. Yeah. So it just went from, one comment being extended, and I think it's overextended in the other direction, saying a lot of rate cuts are happening in a really fast fashion, because remember, the rate hikes also happened in a really fast fashion.
They did. And Yeah, they did. And I would just say that we've already seen, just as what we're 20 some odd days, we're 3 weeks into the new year, and the expectations for massive rate cuts has already started to come down, yet the market hasn't reflected that.
It hasn't.
You would think the market moved up strongly because the Fed was going to cut. Now there's this reality that, well, maybe they're not going to cut as much or as quickly, and the market hasn't moved.
Right.
That's interesting.
That is interesting. And it is really about saying that is the market still kind of clinging on to that hope that the Fed would change its mind and start listening to us, because we are already assuming that there are a lot of rate cuts happening as soon as March.
Yeah.
So I think it's really, the market kind of trying to put that pressure on the Fed that we really want you to do this, because remember in December, you kind of hinted towards it.
And the market tends to put pressure on the Fed a lot. This is not just now. So one of the things that we look at also with the bond market are credit spreads. And what credit spreads are, it's the difference between risky bonds that have a potential of defaulting versus the risk-free bonds, treasury bonds. And that kind of the spread difference between the junk or high yield and ultra high quality. And so you look at that to get a sense for whether or not the bond market sees greater economic weakness. Meaning, if the market senses greater economic weakness, then the chance that some of these higher risk bonds are going to default and lose a lot of money starts to increase. And you can see this here. This goes back to the financial crisis of 2007. And then you've got these peaks where the credit bond spread really widens up to, that's 20%, and then it relaxed. And then you've got the Greek default in 2011. And then there's other spikes. And where we are right now, Bob and I look at it and say, this is the bond market doesn't see any major contagion or spread. And it's important to note that as a data point, because if we saw some signs of economic weakness, this might be a place where we would see it, but we don't see it. So that's what I see.
Yeah, and again, the next slide also is on similar lines, but it also, when we look at this data point, also from an investment opportunity perspective, we also kind of, argue back saying the spreads need to be attractive enough for us to assume that additional risk.
Right.
And the fact that these spreads are not, as in line with what the historical averages have been, kind of puts a little bit of a dampener on saying there is not necessarily a compelling argument for us from an investment point of view to start diving into lower quality.
We need more of an opportunity. And so this just talks about it here in terms of just whether or not the spreads are really wide. And we look at it for every bond type. We don't see really wide spreads. We don't see that kind of opportunity. So you're not going to see us making any significant low-grade bond investment in client portfolios unless there's a major opportunity. So not an area we're going to jump in. Oh, this is your favorite. This is your favorite slide. This is one of my favorites. So
yeah, so we do want to spend a little bit of our time just talking about a few, macro data points. And one of the things that, we've been using this chart in our commentaries for the last couple of years, I would say, and definitely last few quarters, it's been kind of a repeat feature, just because, again, it does provide. Okay, well, first of all, why is this data point important? What is money supply? It's essentially money supply is essentially everything in cash, whether it's, coins and cash in circulation, but it also includes the saving account balances, the money market funds and CDs. So it does kind of give you a scope of how much money is in circulation.
Yeah.
And again, a quick way to think about it is the more money that's out there in circulation, the more economic activity it will stimulate, versus if the money supply is shrinking, that just also implies that there is less money that the banks could lend, that the corporates could borrow, or consumers could spend.
Yeah.
So traditionally and historically, if you go back and look at the history, we have this data going back all the way to 1960s, and the blue line on this graph is the year-on-year change in the money supply in the system. And you would also notice that every time there's been a contraction or been a little bit of a slowdown in that money supply, that also is being followed by those bars, gray bars that you see that indicate recession. So you would definitely see discussions around money supply contraction in current context, saying, oh, historically it has been a really strong indicator that, a recession is on the horizon.
Say every time it goes down.
Right.
Yeah.
So it is, it can be an alarming signal if you just look at it from that point of view. And in that context, if the money supply is contracting 3-4% year on year basis, those numbers are significant in that historical context. But there are two other things that we do have to pay attention and make note of. Is one, if you look at that big spike in that blue line towards 2020, that was because everything came to a standstill. There was a lot of monetary stimulus that was being provided, so there was a lot of infusion of new money supply into the market. And for the last few 2-3 years, we're kind of trying to taper off from that. So it's not unusual for us to see a contraction in the money supply, because we're again coming off of that high.
That's right.
So we do have to keep that into perspective. And then the second point is that again, can't look at just this data point in isolation and say, oh my god, great, bad things and nasty things might be upcoming. All this data point needs to be used in a wider context, not just from that point of
Right.
view.
I mean, we get clients that get those newsletters. It's the doom and gloom newsletters, and it tends to be like that data point gets circled. We're aware of it. We see it. It's definitely alarming, but as Bob has said,
right. So
it's not be all and all.
then again, if you just broadly talk about the macro view on everything, there are definitely a few things that stand out in terms of what the market is expecting or what the last year has been. So for example, look at the chart on the left. There's been a strong growth in 2023. And if you focus your attention on the blue bars, especially for 2023, all the goodness in terms of GDP growth that we've seen last year was predominantly driven by a very, very strong
in 2022 too, I mean, it was also a big component. I mean, it wasn't always positive economically speaking, but once they really came online that second quarter in 2022, it was a huge contributor.
It was.
Yeah.
And the chart on the right makes it even more interesting, just to kind of put things into perspective in terms of what the market is expecting, what the general consensus out there is. That it's been great to see that that recession that everyone was talking about never happened in 2023. In fact, the GDP growth numbers just came out for 2023 and they look pretty impressive. What makes it even more interesting is look at that consensus forecast on a going forward basis. And yes, you do see a slowdown in the quarterly GDP year-on-year growth numbers, but it still stays in that positive.
It's the perfect soft landing, Bhavna.
It's that, yeah. If you visualize that, it is that perfect soft landing. That's the consensus. That's the starting point right now. So
we got another slide on that too. Yeah. Oh, there it is.
Right. So, and again, same GDP forecast numbers. Look at the calendar year 2024 estimates, and we have two different data points here. We're looking at the Bloomberg consensus estimates, and we're also looking at what are the Fed Reserve's estimates, and they're pretty aligned. Again, expecting a slowdown, but not a recession. Yeah. It's that perfect landing leading us to still a 1.3, 1.4% annual growth in GDP for 2024, which would be perfect. The perfect solution.
So we're also saying, Bhavna, just question, is that if we end up getting economic numbers that don't look like that, that's when the market gets upset?
It does. So essentially, so far, everything that we've talked about kind of lands into the two big expectations that the market has. That the earnings growth are going to be in double digits, at least 11%. So it's going to be for corporates, and that we're going to have this perfect, beautiful landing for the economy as a whole. Not just the corporate. US is going to be great. Overall, the economy is going to have that perfect spot. So those are the expectations heading into this year. And if we don't deliver on either of those, there is a lot of disappointment for the market.
Yeah, and that's where if there is kind of that area of open concern, it would be that we're seeing these expectations. this is assuming, again, that kind of like that perfect scenario and corporate earnings have folded along with it. It's interesting.
It is.
Yeah.
But again, the other, no, keep going. That's
keep
fine.
going? Okay.
Yeah.
Yeah.
The other side of that argument is, we've looked at,
Consumer.
yeah, right. Because again, we just made a comment that all the good growth that we saw in the economy for 2023 was hands down driven by a resilient consumer spending. So, and we have all these different charts here that kind of portray the same story. Consumer strength has been good. Yes, we know it's softening from again, what we saw in 2022 and 23, it's definitely softening, but it still stays pretty strong. The debt to income levels for the households are generally still in a very healthy space. The savings rate we know have been pretty healthy.
Yeah.
The labor market has been fairly resilient. Yes, with all the slowness that has been engineered into the economy, we are expecting the unemployment rate to go up a little bit. But again, it's that perfect landing situation wherein the unemployment rate goes up just enough that it would still stay healthy.
Yeah.
And on a real basis, the wage growth is still pretty strong, because we've also seen a little bit of a cooling off in those inflation numbers lately. So that still puts the consumer in a pretty good spot to keep carrying the shoulder, the weight on their shoulders of being able to achieve that perfect soft landing.
Yeah, I mean, I guess, yes, it is. It's just that when you really start to add up how much the consumers have held up the economy, and you are starting to see some of these signs deteriorate. Yes, I mean, debt's been great, income's been great, all of that has been great. It's just a big chasm to jump between has been great and will continue to be great, because we're already starting to see job openings. Job openings are starting to shrink a little bit. So again, we're just going to have to be cautious and careful. And so we have an inflation update. We have to, for a lot of reasons, but remember why it's important. Inflation update's important because the Fed is going to use this as their first line of defense about whether or not they're going to be increasing rates, which that's not what anyone's expecting, or decreasing rates when they feel like it's all clear. Look, the data, here's what you can look at the data, just an eyeball it real quick, and we can get into it more granularly if we need to, but the seasonally adjusted inflation data for producers and for consumers was relatively in line with expectations. It was also very reasonable. It's also very sustainable. This was not the case when we had rampant high inflation. The inflation numbers have come down. The inflation numbers have come down, and every time we get softer inflation numbers or inflation numbers that look good or around what we're expecting, the market loves it, because it's giving them the signal that the Fed's go all clear, go ahead and cut rates. So yeah, so anyway, we would yeah, that's a good question, Chris. We would look at that and say, geez, inflation looks pretty under control. I like this for a couple of reasons. One, this breaks inflation down into 4 different large pieces. Food prices, and I'm telling you, all of our retired clients are feeling the increase in food prices, whether it be at the grocery store or restaurants. We know, we see, we got it, we get it. And this is reflected here in blue. What you'll see is that in 2023 compared to 2022, the rate of inflation for food was much higher. It has come down and improved, but inflation continues to still persist in food. And why is that important? It's important because it's something that it's not elastic. You have to have food. You have to have food. You can intermittent fast all you want. You still have to have food. And so we know that that's there. And then kind of diagonal to that is the service prices. And service prices, if you look, kind of push that chart back, those aqua bars, yeah, the trend is very gradually declining, which means the rate of inflation slowly improving, but it's still fairly high. And I'll get to why that's important. Because you've got energy prices here on the top right, which are showing some signs of coming down, which is good. Again, less money going into your tank means more money to spend. And then goods prices are also coming down, and that tends to be favorable as well, because again, you're spending less on goods, you've got more money to do other things. But the two most consumed areas are both services and food. So it has a disproportionate effect, and those things haven't meaningfully completely reversed.
Yeah.
We're seeing some improvement, although we're aware of it. And I did want to have one, Chris asked a good question about consumers. Yes, we are aware the consumer credit card debt touched $1 trillion. Bob, I'm curious as to what you think, but I mean, my opinion is, real quick, is that the economy is much bigger than it used to be. So I'm not so much worried about that net number as I am their ability to service that debt.
Correct.
And I see inflation adjusted wages that look good. And I see, as you pointed out on this slide a couple of seconds ago, is that people's ability to handle their debt load relative to their income is still pretty good. So any other thoughts for Chris?
Yeah, I think the question kind of goes back to what we were hopefully trying to imply from those slides about consumer, that we know that the consumer is losing a little bit of esteem because those numbers have started to shift around, meaning, for example, the consumer spending through the holiday season was pretty strong. Now one can again think about it two different ways, saying how is this still possible, like where is the money coming from? And when you start peeling some of those layers, it's about the fact that they've had for a while now a stronger household balance sheet, which has given them that legwork, saying okay, we can continue to spend without still getting into trouble. And two, coming back to the service prices chart, there is a little bit of that pullback that we've started seeing, that the amount of money that's being spent on services as compared, I mean, that's also shifting. So it's really about consumer kind of redirecting the spending from one part of the segment to the other is also what's kind of keeping the consumer going for now. But to Chris's question, yes, there stuff like that, the fact that the debt, the consumer credit debt is reaching a milestone number, etc., is kind of circling back into that argument, saying, aren't markets pricing in a perfect scenario wherein nothing can go wrong and none of these data points can derail that hypothesis that we're up there for a perfect landing, because the consumers would just somehow figure out to keep doing what they've been doing over the last 2 years.
Good luck. Sorry. Is that too negative? Yeah, I was thinking, I couldn't help it, but I was thinking, bongo hongo tubby-titus, like I'm hungry for lunch. But anyway, I can't help it. Sometimes it's weird because, like, I don't know, I haven't, been multilingual. I took Latin in high school, so that didn't help. Anyway, all right. Point is, home prices. We're aware that there's a lag. I just wanted to, for some folks, they look at the inflation numbers and say, oh, the housing numbers are wrong. We're aware. There's the adjustment, that's the chart on the right. There's the chart on the left that shows the difference in terms of what the government puts in there. So we do expect to see, as those inflation numbers continually adjust, we expect to see the inflation numbers naturally come down a little bit, because we have seen home prices, whether it be for rent or for own, they have come down some. That will be a net help. Wages as an element of inflation, wages continue to be sticky, meaning, yes, we are seeing chart on the right, less increases to wages, still going up, but less so than they were a couple of years ago. And as we've been mentioning, we haven't seen a dramatic change in unemployment. And as a result, because there's still a high demand for employees, quality applicants, we're not seeing a lot of wage softness yet. So the Fed's got to look at this and say, still see some wage inflation. The housing numbers aren't quite in yet. This thing hasn't been fully baked. As a result, in totality, boom, you've got the Fed target there on the left, and then you've got 5 different potential outcomes. And 4 of the 5 are indicative of the fact whether, if we see 0.3% or 0.1% or 0.2 or even flat, what we are seeing is that in 4 out of 5 instances, it seems likely that the inflation numbers are going to be moderating and slowly improving, further giving credence to the fact that the Fed can, if they want to, cut rates. I just think what gets lost in this whole thing is that the historical aspect of it, and that is, in the 70s, we had an inflation problem, and then the Fed raised rates, inflation came down, the Fed then cut rates. We had the second leg of inflation that was brutal, which took Volcker to increase interest rates up to 15% in order to get that tied off. That's part of the reason I think why the Fed has been saying higher for longer, because they learned a lesson from the 1970s. But so the story isn't yet written, and I'm aware that it's better. I just don't know if and it seems like the market got ahead of itself and what it's expecting, because I've seen the 10-year Treasury, which went down over 4, is now over 4. I've seen the 2-year Treasury, which was up over 5. Now, again, startlingly lower than it was. So, and it's also starting to rise a little bit. So the 10-year and the 2-year Treasury are good data points to follow, which is what's all about interest rates. I'm going to keep rolling. Rolling? Okay. You know me. Once I get going, it's like it's hard to stop. Okay. So the story has always been about interest rates. It was hard to choose which chart, Bhavna, but because if you look at the 2-year Treasury or the 10-year Treasury, they both have really good historical context in that when those rates are stable, the market can perform. When the 2-year and the 10-year rise, and if you want to look for reference while I'm talking about the chart on the right, when the 2 and the 10-year rise, and when those things are going up, the market tends to perform poorly. And it kind of is the case. And then you get to the first half of 2023, rates were stable, market did well, rates rose, market fell, declining interest rates, market went up. I mean, this is, guys, if you're looking for, if you're looking for kind of that direct causation, there's a lot in there between the 2-year and or the 10-year in those things rising and falling in market performance. The only thing we need to know, Bhavna, is whether or not the 2-year is going to go up or remain stable, and the same with the 10, which is part of what we're trying to unpack with all of these data points.
Right. And that's why consistently everyone in the market pays so much attention to what the Fed's next move is going to be on those interest rates because of this
direct relation. Yeah. Right. And so what does the market expect? There on the left, 4% is where we ended the year. 2024, the expectation is 3.25. So the market's expecting the 10-year Treasury to be down 75 basis points, which ties into some of the earlier charts, which would show if that does indeed end up happening, then that would be a cause for the market to rise. Again, I think that story has yet to be told, because this was the expectation. It was going to go down to 3.25. And we are already moving in the opposite direction. And you would think, Bhavna, if I had said to you, hey, to start the year, the 10-year is going to go from 4 to 4.15 or 4.15, and the 2-year is going to go up. Where's the market going to go? You'd say market's going down. That hasn't yet been the case. We've seen the market rise a little bit in the face of that, which goes against the historical context.
Right, and which one can kind of also look at it from this point of view, that does that kind of create almost a catch-22 situation and scenario?
I know where you're going. Yes.
Right, because what would truly convince the Fed to lower interest rates? They do need to see more in the market for them to be convinced that, okay, it's time for us to start reversing the effects of this, tightening that we've been doing, and it's starting to show in the riskier assets. What would it take for the market to keep doing well is the expectation that the interest rates would go down. So what is really the trigger? Like, one feeds the other. So I mean, I feel like there is no, it's not as clean cut, simple, clear thing. The Fed is ready to cut rates. They're not, because they're still looking for signs. And while, like you said, the inflation readings improving in the right direction is definitely giving them more comfort to say, if we wanted to, we could. But the biggest question and the elephant in the room is this time to actually start acting so fast on those interest rate cuts just because the market is expecting us to?
And we have an election. Anyway, we're not going to get political. There's really no cause to get political yet. But what the Fed is expecting is there on the left. And you can see 2023, 2024, 2025, 2026 as you kind of move along the right-hand side. And then you can see from top to bottom, each one of those dots is what someone and a representative of the Fed is thinking. And then you can see 2024, where they currently think that interest rates are going to be going lower, and then 25 still yet lower, 2026 yet lower. Over the long run, you can see where they all want interest rates eventually to settle into that 2.5% to 3% range. The dot plot is a good way for us to understand what market expectations are, what the Fed expectations are, but this does not translate into reality.
It does not,
you
because
know.
it still kind of leaves enough room open for
Yes.
how those cuts would be done, what would
Yep.
be the pace, what would
Yep.
be the gravity of it, etc. And again, obviously the market did read a lot between the lines in December to have that kind of a reaction saying,
Yep.
we figured it out. We could truly read these dot plots and know exactly what that path is going to be.
Yeah, I mean, and it's interesting. And the stuff on the right just shows whether it be the PCE or GDP in terms of economic growth or unemployment, how the Fed, as they were increasing rates, those producer costs, our US economic output and unemployment, each one of those three key areas, improvement with a very tight interest rate increase that's been amazing. And then the expectation kind of folded all in together, which is that the market is expecting, again, as we keep saying, the Fed to cut dramatically. The purple shows what the Fed is thinking on aggregate. The difference between the yellow and the purple is pretty significant, because we may have none of that. We have to wait and see, because I think the market would be very disappointed if we don't. This one's good.
It's good, but maybe we just pay. Again, we'll talk about a lot of this. What's the big takeaway from everything that we've talked about in the conclusion slide? So maybe we get there then. Real quick, just talking about, based on what 2023 has done, what is our expected return forecast specifically for the equities? And I know it's a very busy slide here, because what we did was we took our model and not just ran it on the S&P 500 index, but we also kind of did a few more variations of it this time around, which interestingly kind of brought a lot of relevant insights that we should be paying attention to. So the other two variations of it was just looking at the same S&P 500 index, but on an equal weighted basis. And while we were at it, we were also looking at what the model is indicating in terms of expected returns for the small cap segment of the market. And there is a table on the bottom left, which kind of draws the big takeaways from these three tables, because I know these are busier tables, but the idea here is that if our assumption is that the annual real GDP growth settles at around 2% over the next 7 years, and we assume a forward PE multiple of, let's say, 18 times, which again, from a historical reference point, is a little more reasonable. For the S&P 500, the average annualized return would be around 6.4%.
Bet you this works.
You can probably start pointing it in the table on the left.
This one here?
No, on the
bottom.
yes.
Oh, okay, got it.
Yeah.
Okay.
So for the S&P 500, assuming an annual real GDP growth of about 2%, a forward PE multiple of about 18 times, that translates into an expected annual return of about 6.4%. But if you look at the same index on an equal weighted basis, that number jumps from 6.4 to 9.2, which circles back to all the conversations we've been having about that concentration that's become such a phenomena with the S&P 500, that if you just change the weightings, it just leads to completely different results. Again, granted that you can use exactly the same valuation multiples for the small cap segment of the market. So what if we assumed a PE multiple of 15 times for the small cap?
That's right.
The expected annual earnings for the small cap is about 11.8%. So it just kind of goes back to all the discussions that we've been having, that there's so much disparity between what's on the surface versus beneath the surface. And if you just slice and dice the data and look at different segments of the market, you actually end up getting very different results on what might be reasonable expectations from over the 7 years.
And I look at it like there are areas of opportunity. It may just be outside the S&P 500, and that's essentially what you're hiring us to do, is to find and identify those things. I'm going to go ahead and go through the conclusions. We have a keep the questions coming. We have got a basket of them, so I'm going to try to get through this, and then we're going to go through some of the Q&As. So again, feel free to keep them coming, and Chris, you're not beating anything to death. Don't worry. Go ahead. You can ask, fire away. So the conclusions are really into three, big buckets. We're aware of the geopolitical risks, and war and conflict, again, not on US soil, tends to be something that is largely and very unfortunately a positive economic event. It tends to be more dollars spent. So we're aware of the major conflicts. We're aware of the national elections that are not just here, but across the world. That will end up likely creating movement in the market. It does, whether or not that movement is positive or negative, I don't think that's really that's not going to be the determinant. That's going to be a volatility thing. It's not going to be a determinant of performance. The determinant of performance is the corporation's ability to deliver that growth, whether we're going to see good US economic growth overall, and we will pay attention to all those other factors, but they're not going to end up forcing the issue, I guess is the way I would put it. So, if the Fed's right, and the Fed, if we do see, my goodness, all of those interest rate cuts, you would think it would be in the face of a recession. So
Right.
if the Fed does see a recession coming, then the market certainly hasn't priced for it. No one's forecasting that. And if you're waiting for the Fed to have this announcement that we're going to have a recession, that's not coming. The Fed is a cheerleader. The Fed is all the things that are great and going on and what they're doing in Fed speak. That does not tie in with the Fed telling you exactly what they think is going to happen. So again, balance and diversification is going to continue to be a key. You should expect from us potentially less magnificent 7. So on equities, on a pure valuation basis, we're underweighting the Mag 7. I think that Apple again is flat on the year, and Tesla is strongly down on the year to Mag 7s. And I think that just that sets the stage that even if you're a magnificent 7, albeit you've got great pricing ability, you've got great balance sheet, you've got AI as a
Right.
tailwind. I get all of that, but it's not necessarily a license to be one of the greatest 170 growth companies in the world that are going to grow their earnings by 25%. So I would expect to see us eventually over the course of the year bleeding into other different areas of the market to get you exposure, because as Bhavna just showed you, there's maybe a little bit more volatility by being in some of those other, like the equal weight or small cap, but when we do start to get you into those portfolio mixes, it'll be at a time where we think there's less downside, because those things, if we do go into recession, could get hit very hard. So as a result of all of that, our hedging portfolios, our EIO equity income and option portfolio, our ability to provide downside buffers are increasingly and incredibly important. So you'll see continued use of those. So I would expect to see some more of that. And in fixed income, whether or not we see those credit for spreads widen, and there's this thought like, oh no, are we going to have a recession? Are these companies going to default? If we see opportunity there, we'll jump at it. But again, we don't see it. Okay, disclosures, the thank you, and let's get to some questions. Let's get some questions. Okay. I don't know. Do you want to do this one? Oh, how about you do this one? The outcome of the presidential election and how it will affect the market.
We said we are not going to talk politics.
I didn't say pick the winner. I said and who's your favorite. I'm saying, so if it's a Republican, Democrat, or independent, or who knows what happens in this election outcome is, how Bhavna, is that going to impact portfolio allocations?
It's not that's again, we are very, very aware and conscious of the fact that it is an election year, but we are always kind of leaning towards what the historical market references have told us, that the market doesn't necessarily care. It does like a gridlocked situation when it comes to the Congress, etc. So that's usually the sweet spot for the market.
Yes.
And kind of leaning in one direction or the other can create extremities. but we're not necessarily going to make portfolio changes very, very specifically for what may end up trying to predict what the election outcomes might be, because we know it will be a very closely contested election, and then the outcomes are going to be hard to predict.
They will be. But just know that we have to read and react.
Correct.
We got to read and react. So if it's a Democrat win versus a Republican win, or vice versa, our portfolio sector favorites and sector losers will be changing that accordingly. Good question on the dot plot. How long has it been around? I think 2012. And how predictable. Yeah. I mean, look, it's an incredibly accurate reflection of what those Fed respondents think about the market and the economy. That it does very, very well. But what it also does well, and the way I want you to use it as an investor, is to understand how the market's pricing things in. The dot plot is a reflection of what the Fed thinks is happening right now. The Fed will then change their dot plot answers based upon the economic data that comes before them. Right. So we use it as a tool to say, here's what the Fed thinks now, and it confirms kind of what their economic expectations are. Right. And so when Bhavna and I say, like, the Fed is expecting to cut rates, we then look back to the historical context and say, well, when the Fed cuts rate that much, what does that usually signify? It usually signifies a recession. So we'll have to wait and see. I hope I answered your question. I got another one here about, yes, consumer credit card debt's not a concern, but what if the job market slows? It slows. And again, I think that, I'm not sure it's the goal of the Fed to slow the job market. It's to have a controlled and reasonable rate of wage growth and joblessness. Does that create an issue with the payback of debt and increasing write-offs? No, I don't think so. The payback that we've got $34 trillion of US debt. We don't pay that debt now. We just issue more debt to pay that debt. So I don't see that as an issue with write-offs. Yes, we are aware that there's layoffs in the tech industry. Hard to say whether or not that's an Elon Musk style series of layoffs. So when I say Elon Musk style, I'm referring to Twitter. And when I'm referring to Twitter is that he took a fresh look at what Twitter was doing and said, we can do the same amount of work with a lot less people, and other tech companies are taking notice. So there's kind of that Elon Muskification of the bloat that was in some of the tech hiring. So yeah, we're seeing some reversion to the mean there. But also that all of those tech layoffs added up in aggregate is not creating a job market total wages and job market change nationally. So we haven't seen anything more meaningful there. In our companies essentially preparing, by the way, Chris, that's a loaded question. Are companies preparing for a recession? No, I don't see anyone, preparing for, or companies preparing for a recession quite yet. But what I do see them doing is, leaning out their staff. One would wonder if use of AI is starting to creep in a little bit. We know, here, I guess I should say that at InterOcean, we are already working on different AI tools organizationally that are going to help us quickly evaluate pricing, multiples, history, graphs, charts, and data, so that we have, we need more information. We need more data, but data that we're creating in-house, super cost effectively. One would think that makes us more efficient. So yeah, I think that I answered your question. So no, I don't think companies are preparing for a recession. I think that companies are actively trying to lean out their staff and to be very efficient. Call it a Muskification, if you will. An Xification, a Twitterification. Okay. So Bhavna, what do you predict the impact of ESG will be in 2024? And what impact will it have on investors, if any? ESG. Wow. Let's do it.
Yeah, I mean, I don't think I have any specific opinions on ESG in the context of, specifically for 2024. I feel like that theme and trend has anyways lost a lot of steam. Right. Again, because there was generally a lot of greenwashing going on, that idea. And those screeners, etc., still not as evolved as they should have been, etc., etc. But again, I don't have any specific thoughts in the context
I
of
got some.
2024.
I got some. So, look, I mean, I've been on the board of a few solar companies. So, and solar companies tend to be a beneficiary, solar engineering construction companies. They tend to be beneficiaries of ESG seekers, people who are looking for, green investments. I can tell you that there's still a lot of optimism there. There's just definitely a lot of capital. I'm sorry, a lot less capital than there was. So I think 2024, if it's a reflection of what we saw in 23, there's less money actively seeking its way into that space. I do think that we're going to continue to see investments in alternative energies for sure. And we are all of the above, oil, natural gas, new nuclear, old nuclear, all of the above. I mean, we are very much agnostic in terms of how the energy is going to get created, but we know that we just can't immediately get off of oil right away. So as a result of an eventual transformation of our economy off of burning hydrocarbons onto something that's more renewable, there will be this kind of continued and gradual move into ESG. I'm just glad the question wasn't on DEI. Too much of a hot button for me. Bob Knock, how about crypto? Bitcoin's on fire. Bitcoin's on fire. We should have had everybody's money in Bitcoin.
No.
Okay.
I would say that having the ETFs finally launched does provide a little bit of stability and better structure to the crypto market that I am excited about. Does that mean that it becomes a viable investment option for our portfolios? The answer still is a resounding no, because again, there is a lot that still needs to be figured out about the true implications and true use cases of cryptocurrency. And I've always been saying this on this topic, that the amount of attention that was put on cryptocurrencies as an investment avenue has been overshadowing everything else that it stood for. And in that context, I think having these ETFs available would take away some of that kind of excitement that I can't invest in it, makes me want to invest in it more. Now that you have proper channels available for investing, I think that hype would start normalizing a little bit. It'll become another avenue for you to look into and analyze properly. So I'm excited about that. But other than that, again, from our portfolio construction point of view, I don't necessarily see it becoming a component anytime soon.
I just want to say something about crypto. I want to say something. So is that crypto becomes incredibly important and incredibly useful the minute that you can use it to buy everything. Or to buy a lot of things, or everything would be the ultimate, until such time as there's general acceptance to use that as a purchasing mechanism. It is all kind of built on speculation. It's all built on kind of the greater fool theory right at the moment, in terms of I'm gonna buy this today, and who's gonna pay me a higher price. And that eventual approval which happened of Bitcoin as an ETF, there was just this huge rampant move, because everyone thought, oh my gosh, retail investors and institutions can now use these ETFs to buy it and transact Bitcoin easily. What's going to happen is, and then BlackRock's going to issue this ETF, and they're going to raise $1 billion, and then they're going to have to go out and buy $1 billion of crypto, and that's going to create and spike demand. That hasn't happened yet.
And I don't really see that happening, because it kind of goes, you have to look beneath the surface. Is there anything really truly to explore there? And the answer so far has not been a convincing yes. So
well, if you want to do it, go ahead and do it, but just be reasonable with it. And we also just don't yet know what the ultimate crypto winner will be. It'll be the one the government allows to transact business in.
I think it all comes down to use cases. As long as you can define good, solid use cases, that cryptocurrency might win the battle.
We got through the questions.
We did.
We're done. We're doing the questions. All right. So, domo arigato gozaimashita, which is like, thank you very much. I really appreciate that.
I believe you. I don't know any Japanese. So must.
Well, then let me just give me
I
that one
hope
thing.
you're saying it
What
right.
is if I didn't? What is if I'm saying something just totally?
I know.
I know. Well, you know what's funny is that I thought my pronunciation was like really perfect. And in Japan, if it's not, they just ignore you. Yeah. So no, so I would if
That's
I
fair enough.
it is fair enough, but it's not like, if I'm saying like Shikansen, but I'm not saying it in a way like bullet train. If I'm not saying it in a way that they recognize, I could be talking to an employee of the Shikansen and he won't respond to me. Anyway, so I did the best I could. We did it again.
We did it again. Thanks everyone for joining us, and thank you, Michael, for flying in and
I loved
doing
it.
it in person with
Thank you
me.
for not having snow. We appreciate it. Thank you very much. Send us your emails, questions, thoughts. We've recorded this. We'll launch it soon on the website so you can watch it 3 or 4 times because we know once isn't enough. It's never enough. Okay. Thanks so much. Take care. Have a
Bye.
wonderful day. Bye-bye.